Hey, folks, welcome back to Money and Politics on January the 5th. And not a great day to be talking about the market because the market was sharply down today, and it was a bad day for virtually everything that's out there. So it's a cold day in the Midwest. We're going to have probably the coldest day of the year so far, and it's going to get colder tomorrow. And this is not going to be an uplifting necessarily video. So I'll caution you about that. So I'll make this rather quick. One of the things I think of the stocks that you might want to take a look at, I'm going to give you a couple of things to look at as a reminder. So with that, let's take a look at Zynex, which we've talked about before, the radio devices, electronic devices that cut pain in patients. And that, as you can see, went up 27 cents today. It's still only at $9.30. But it has been, in recent times, if we look at a 1-month chart, it was just about a month ago up at just around $13 a share. So if a month or 2 months from now it was at $13 a share from where it is today, that would be up $4, which is almost a 50% move from where we are at this time. And you can see a 6-month chart. The earnings also, if we look down on the right here, you can see where for the last 3 quarters, Zynex has beaten the estimates. You can see their revenue numbers. We're looking to get some updated numbers here. And they go with, as I recall, the same quarterly earnings. So we're going to have to wait for the earnings that will be coming in for the fourth quarter, which ended at the end of the year. But that is one stock that you might want to take a look at. The bad news, and there's a lot of bad news. One of them is, of course, Humble, which was down again about 8.7% today, and the volume was about in line with normal, 5.6 million shares. This is a 1-month chart we have. If we look at the 5-day chart, the problem that we have right now with Humble, one of the problems I think that is, we have no news coming out, and we're going to have to wait for the revenues, and we're going to start to get that, when we get to around roughly Valentine's Day. So short of any news coming out, if this is going to be another kind of a quiet period for Humble, then we're probably just going to be bouncing around here for a while, unless there's some announcement or some catalyst to have us get Humble, spark more buying. But that said, that's where we are. And I think 2022, the thing about Humble, let me put it in context, because I'm going to say basically we have a bad market today. I think we are going to have a challenging market this year. And what does that mean? That means that the average is not going to be going up like it did last year. Last year, the S&P 500 was up 27%. I think the year before that, it was up 16%. So we've had a number of good years on the S&P where we could just kind of have the market going up for a number of years. Now we're going to be raising interest rates, and that means now the market's going to have to be swimming against the tide. And we're going to quite possibly have to be looking at how do we, what's our strategy for a market that is going to be going down on average instead of up. Now, the thing I would say about Humble is because Humble's come so far down over the last year that, and let's just real quick look at a 1-year chart, and you can see, because it's come down so much over the last year, that I think there's not obviously too much more downside available here on Humble, maybe on a percentage basis. We were not too long ago down to 21 cents. That was the bottom. And that was where about December, the end of December 30, I think that says. In fact, I bought some that day. So I think we could, it's all going to, with Humble, it's all going to depend on the revenues. That's what it's going to depend on. Now, I have talked about the TQQ many times. I have talked also about the opposite of the TQQ. The TQQ, if you don't know, is the 3 times leveraged index version of the NASDAQ. If we have a very challenging year, if the NASDAQ were to be going down from these levels, and by the way, don't forget the TQQ is going to be splitting 2 for 1, as will the UPRO, which is a 3 times leveraged version of the S&P 500. Both of those are going to be splitting on the 11th, and so that's 6 days from now. On the 12th, it will open split. So that means that if you bought 1 share on the 11th, on the 12th, you would have 2 shares at half the price as it closed at on the 11th. But that said, what I wanted to get at is that here is the opposite of the TQQ. The S, as in short, and that is a 3 times leveraged short on the NASDAQ. So with the NASDAQ today down, and we can, let me see if I can get that number. Where do we come down? The NASDAQ today was down 3.34%. So what you see is the SQQQ went up 9.38%. And this is the 1-day chart. So that's a way that you can, this is not, by the way, something I typically don't keep a short on the market long term, because long term we're going to be going up. But if you wanted to take some amount of money, a smaller amount of money, and you can use this as a hedge against the market going down. And if we get a market where it shoots up, just yesterday, what is this, 5-day chart? So you can just see here on Monday that we were at $5.74. So we're up, 50 cents? 75 cents. If you had bought 1,000 shares, I mean, just to make math simple, let's say you bought 100 shares for $574, you'd now be up close to $75. I'm just doing the math off the top of my head here. So if you had 1,000 shares at $5,740, you'd now be up approximately $750 or so. Without using a calculator, I'm just rounding off. You get the idea. The SQQQ is a short on the NASDAQ. And if we had the NASDAQ take a sharp drop, if we start to get into a year where with interest rates going up, we have the markets going down, then to take a position here, I almost bought some yesterday. I held off, and of course now I would have been up 9%. But this is one thing I wanted to bring to your attention. The other thing, and as you know, if you're on Facebook, you post things and things come up in your memory. So this came up today, which is kind of interesting. This is a post I had put on Facebook 7 years ago, January 5, 2015. And I'm going to read this to put in context my closing thoughts here. And I said, as I write this, the Dow Jones is down 323 points. The S&P is down 1.8%. And why? Because energy companies in the average are pulling the markets lower as oil prices fall below $50 a barrel. And by the way, as I record this on January 5, 2021, oil prices are currently at, I thought I had it right in front of me. oil is at $77. So back then, oil was going below $50 a barrel. This is a perfect example of where the markets get things wrong in the short run, which creates a buying opportunity. And as I say here, do you think cheaper oil is bad for the economy? Neither do I. Think how much greater the profits will be for all those firms that use oil in the manufacturing process, like plastics. How much cheaper energy will help firms like UPS and FedEx, transportation firms, airlines, railroads, not to mention the family budget. And lastly, as I'm sure you know, how much more money consumers will have in their pockets to pay down debt and to go out to dinner and spend money on other things. By the way, 60%, 60% of the American economy runs on consumer spending. So with that in mind, I go on. The bottom line is cheaper oil is actually great for the economy. Yet here we are with stocks falling hard. It doesn't make any sense, does it? And one key reason is that you want to invest for a period of 5 years or 10 years, while Wall Street is often investing for a period of 1 week or 1 month or to the end of the quarter. So zig when others zag, and take this as a lesson of how so many of the so-called smart guys and gals on Wall Street can be beat with a little common sense and a bit of patience. And folks, that's, I wrote that not just for 2015 at that moment, but I've seen this over and over again. The people on Wall Street, the guys who are running the mutual funds and the pension funds and all, they often get these things wrong. And they are looking on a time period of earnings that they want to make the quarter, and they don't look like you and I would be looking as in the longer run. So if we get into a period now where the economy goes down, and by the way, again, that was January of 2015, when we had January of 2016 start, it was like someone threw a switch. By the way, 2015, as I recall, I'm not quite sure, I'm going from memory, I think that ended up being a good year. 2016, it was just like bang, and the market fell, and the first 6 weeks of 2016 were brutal. The market just went down, 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 and it wasn't until we got to about the third week of February of 2016 that we kind of started to climb out of the basement. And we went on to have a pretty good 2016. Now, that said, this is why, by the way, on the chart on the NASDAQ, I don't like to hold that for a prolonged period of time. But in the near term, if you can't stomach to see your portfolio go down, the SQQQ is a way to hedge, because that goes up as the NASDAQ goes down. It is a way to hedge your portfolio, at least the portion that you have monies in the NASDAQ index. Okay, so those are a couple of ideas. One is that if you're buying for the long term, patience and time is on your side. I've never seen the market go down where it doesn't come back up after some period of time. Even the sharp downturn we had in the fall of 2008, we hit the bottom on March the 9th of 2009, and then we went on more than a 6-year bull market. We went on about a decade-long bull market, the longest bull market in history. What were people saying after we collapsed in September of 2008 and fell out of bed and went down 40%? They were, oh, this is bad, and here's what you ought to be buying for safety, and here's where you ought to be parking your money, and things that, we're never going to bounce back. My experience is, that's over 40 years, if you have a market that falls off sharply, that's a good time to buy. And I've talked about this before. Build up cash in your portfolio for when we have these downturns. Now, we had a downturn today, but it's a one day. And, while it was, a sharp sell-off, it wasn't just god-awful disastrous. I mean, the old days of when the market fell 50 points, and that was bad news, are long gone. So we might, who knows what we're going to do tomorrow or the day after or next week. We are going to have, in the course of your investing career, we're going to have years or a year where the market ends up the year lower than where we started off. I mean, you're going to lose money. There have been times where the market finishes down 15 or 20% on the year. That's going to happen. And you just have to know that's going to happen periodically, which is why you don't want to be putting your grocery money in the stock market. You don't want to be pulling money out of the market when your stocks are all beaten down. This is also why right now, because we're coming into an environment where this could be a brutal market going forward. I don't have a crystal ball. I'm saying why it could be a brutal market. Because we were at all-time highs, and now we're going from an environment where we had the historically low interest rates to where we are going to have multiple years, probably this year, the year after in 2023, and probably the year after in 2024, where we are going to have the Federal Reserve raising interest rates. So and I've talked about this earlier in the year, that's going to be changing the nature of the game that we have been operating in for the better part of the last 10 to 12 years, going back to 2009 when the Fed cut interest rates dramatically so that we would have more liquidity in the market after that collapse of the real estate environment back in 2008. So, folks, that's what we have tonight. It's not always going to be cheery. As far as humble, as I say, we're going to have to wait for the revenues and the guidance. Keep your fingers crossed that these numbers go up on ticket sales, on NFTs, on EXTs, or ETXs rather, and that we get the transactions going with the app, so that over the next 3 to 5 years, we're going to be seeing a steady increase in revenues. As Jim Cramer says, there's always a bull market somewhere, and we look to find it. Sometimes the bull, at least in the short run, might be where you have to be buying the environment where you buy something that goes up as the market goes down. Again, if you buy the SQQQ, don't sink too much money into it, and don't look to buy this for the long run. I typically buy for the long run, but I don't short the market for the long run. So, folks, that's it. I'll let you go right now. As always, we'll try to keep in contact. Leave me your thoughts, and you can write me always, as you know, at moneyandpoliticsnow@gmail.com. And if you want to follow me on Twitter, that is right there. In the meantime, have a great night, and we'll talk to you again soon.